In. This is India Tonight, and my name is Mathew. We're focusing on the latest macroeconomic data in our big story tonight. Inflation is something of a worry here in India, with elevated crude oil prices expected to result in higher prices across the board. Now, earlier this evening, retail inflation print for the month of February was released, and the CPI inflation came in at 6.07% on the back of a rise in the prices of manufactured goods. That's an 8-month high, and it's also higher than most of the estimates. It remains above the comfort zone of plus or minus 2% that the Inflation Targeting Monetary Policy Committee of the Reserve Bank of India is mandated to achieve. And what's more, wholesale price inflation, which was released earlier in the day, continued to remain in double digits for the 11th straight month. It came in at 13.1%. Let's talk about the implications primarily of the retail inflation print. Joining me now is Siddhartha Sanyal, the chief economist and head research at Bandhan Bank. Thanks so much, Sidhhartha, for taking the time. This is the print that came in for February is higher than expectations. I want to understand from you as well what your expectations were. But alarm bells, do you think, or is it too early to say? Do you think that some of this will settle down with crude easing out?
Yes and no, in the sense we were expecting a number in the high 5% kind of a zone, close to 6%, but lower than 6. So that way it's slightly higher. The other significant thing is that it's above the upper threshold of RBI, which is at 6%. But having said that, the RBI governor in his previous monetary policy meeting, he mentioned very categorically that he expects that 1 or 2 readings to be higher, basically on the basis of statistical effects. Now, while it might still be might have been caused by the statistical effects, what has changed during the course of the last 4 to 6 weeks has been the geopolitical tension, which is leading to a lot of complications for a lot of commodity importing countries like ours. So while this particular print might be seen as some kind of a result of some kind of a statistical effect, the worrisome factor is that a lot of commodity prices are on the rise. As you have seen in this particular round, manufacturing prices had been very high. Also, if you see from the WPI price inflation, that means industrial commodity prices generally remain pretty high. So there had been a lot of price pressures of late, and that will be coming through. As of now, till February, we haven't seen the pass-through of crude oil prices to the domestic pump prices, which might also take place at some point of time with direct as well as second round effects. So there are undoubtedly a lot of pressure points for the inflation trajectory in the coming months.
What are the implications, though, Sidhartha, in terms of what both the government and the RBI had estimated? This is on the back of expectations that crude oil prices will remain perhaps a little elevated, but not where we're seeing it. And while they have cooled off to $105 to the barrel as we speak, they are still significantly higher than what the RBI was estimating, which was around $75 to the barrel. What could happen to the estimates, one, and the pressure on the inflation targeting central bank to adjust monetary policy accordingly?
Very pertinent question, Alex, and very clearly from while 105 in the context of the last few days or last couple of weeks might see a bit of cooling off, as you mentioned rightly, from the RBI's and the government's expectation of about $75 odd a barrel, this is still about 40 odd% higher. So, and if oil prices remain higher, I mean, when oil prices go higher by about $10 a barrel for 1 full year, that straight away adds something like half a percentage point of GDP to the country's current account deficit. So the pressure of this 30 odd dollars per barrel is equivalent to something like 1.5 percentage point to GDP on the current account front. Now, if you try to subsidize domestic oil prices, there is a pressure on the fiscal situation. There is a pressure on the consumer confidence part. So there are multiple implications. Now, in terms of what the RBI prioritizes, as of now, we have seen while there had been a lot of pressure points, RBI continues to provide a lot of support or push into growth. And there, in the month of April, it will remain critically dependent on the RBI's evaluation, whether this pressure are there for maybe half a quarter or 1 quarter, or longer than that. If it is longer than that, then the pressures on RBI will be significantly higher compared to what had been the case till about February. But if the RBI still judges that this particular phase is some kind of a passing phase, they might still try to provide some more cushion to growth and still go slow.
So much, Sidhartha, for joining in. The question really remains, will that accommodative stance remain? Will there be some move to normalize in the form of perhaps a reverse repo hike in the April policy? Thank you so much for taking the time.
Pleasure.